So today we're going to be doing something a little bit different. We're going to be digging into a hypothetical portfolio. This is something that we offer at Pure, and I thought it would help you guys understand what actually goes into this, because there's a misconception that financial advisors know what they're doing when you're talking about portfolio construction and portfolio management. And there's a few things here. One, the barriers to entry to become a financial advisor are basically non-existent. It's been said that the credentials or the onboarding process to become a hairdresser are more intensive than a financial advisor. And the second thing is there's no continuing education, there's no portfolio management training. And most advisors either outsource the investment management to a third party or they outsource it within the company. So it's very rare that a financial advisor themselves would be the portfolio manager on a client portfolio, which can be a good thing if they don't know what they're doing. But there's a basic rule in our business where the more people that touch the money, the higher the cost. So you're paying an advisor a management fee. They're turning around and outsourcing the investment management, like to a mutual fund, a hedge fund, a separately managed account, a TAMP, which is a turnkey asset management program, which might charge another 1%. And the client is footing the bill for that as well. So you stack all these costs up and it becomes a drag year in and year out, and it can really add up. So I'm going to be focusing on a few things. One, like I just mentioned, is the cost of the overall portfolio. At Pure, we're big on optimizing the things that we can control. And there's really 5 things that we can control for sure as a professional investor. One is cost, right? So how much you're paying all in for the management of the portfolio. 2 is the tax efficiency. This is really the low-hanging fruit. And we're not CPAs, but there is a way to structure a multi-asset portfolio to maximize your net after-tax returns without having an opinion on what the market does next. It's just where you own certain asset classes can have an impact on your net after-tax return. The third is just portfolio construction. Is it a soundly built portfolio? Does it pass Portfolio Management 101? And again, going back to my opening comments, there's just a lot of flagrant fouls, if you will, or egregious allocations that are not rooted in evidence. They might be rooted in a narrative, or it might be a conflict that the advisor has. Their company that they work for is pushing a certain product or a certain style of investment that really is more story-based rather than evidence-based. The fourth thing is risk. How much risk are we taking? Is this portfolio a risk-efficient portfolio? And, I've written about this in the past where a lot of investors obsess about their net of fee performance, which is great. It's great to understand how your portfolio is doing, but they have zero context on the journey. They don't know if the portfolio is optimized for both risk and return. And the example that I always use is if you were shown 2 portfolios side by side and the only thing that you knew was each portfolio performed 8% last year or achieved an 8% rate of return last year, and you couldn't see the holdings and you couldn't see anything else, and someone asked you to choose the superior portfolio, it would be impossible. So risk, context into performance is a very big deal. Lastly, conflicts. If someone shows me their statement, within 30 seconds, I can tell you if they're working with a salesperson or a professional investor. And it's really that simple. There's a few things that stick out as egregious: A-share mutual funds, non-publicly traded REITs, C-class mutual funds, annuities, non-liquid securities, mutual fund hedge funds. I mean, there's so many pieces that go into this, and it's obvious when someone is giving conflicted advice, or they're strictly shoving what their company is telling them to shove down their clients' throats. Okay, so without further ado, let's get into this. So this is truly a hypothetical portfolio, and I'm going to bounce around a little bit, but again, we're going to be looking at cost, tax efficiency, portfolio construction, risk, and conflicts. So my dog's name is Bush. This is Bush Schuurmans' portfolio, bush@kibble.com if you want to reach him. And this is actually nice because we have a taxable account, right? So this is monies that you've already paid taxes on, and you go ahead and invest those. And then an IRA account, which this might have been an old 401k or just an IRA that was built up over Bush's career. And there's a few things that jump out to me right off the bat. Okay, let's start with the cost avenue. I have not looked up these expense ratios for these mutual funds, but mutual funds are notorious for embedding an annual cost that doesn't show up on your statement. It's not itemized on your statement, but rest assured, if you own mutual funds, you are going to be paying 0.3 to all the way up to 2% to own that fund each year. And the fund companies are smart. They don't want you to notice this, so they take their fee every day, and it might be a sliver, it might be $1, it might be 50 cents, depending on the amount that you have invested, but they take it every day to smooth out the effect. And again, you would never notice this, but when you add up the management fee, the expense ratios, you can get up there in percent, and that's like running a race with your shoes tied together. So if you do own mutual funds, just be mindful, there is an embedded expense here. Looking down here, several of these kind of exotic exchange traded funds. So this is an equity buffer ETF. So that's probably like a structured note where, they might say you have a cap on the downside, so you're protected on the downside, but we're also going to cap the upside. So let's say the S&P did 20%, you might only get 10% of those gains, but if the S&P lost 20%, you might only realize 10% of those gains. So kind of a fixed range tool. Again, I haven't looked up these expense ratios, but these are probably pretty hefty. And again, we own a couple mutual funds here, so I'd want to understand this First Eagle fund and this Wildermuth endowment strategy. This probably carries a heavy expense ratio. There's an A share here, which is a red flag, and no surprise, the firm offering that. So how an A share works is not only do you get the annual expense ratio, but let's say you invest $100 into this mutual fund. Most A shares carry a front end load of, let's say, 5.75%. I believe that's the highest threshold that they can charge. Instead of $100 getting invested into this Morgan Stanley growth fund, you would only be investing roughly $95 into this fund, or $94.25 if it's the max 5.75%. So right off the top, you're giving up almost 6% to this mutual fund company or to the broker, who often receives a kickback. And then for the privilege of doing that, your $100 is turned into $94.75. They're going to charge you a management fee, right? Because an advisor is managing this portfolio. And they're also going to charge you that embedded expense ratio. I mean, in 2021, that's just asinine to give up all of that to a conflicted salesperson. So work with a professional. Work with an independent firm that's a fiduciary, and you won't have to deal with any of this stuff. So taken all together, you might say, okay, Nick, I own mutual funds, but how much am I actually paying? Our software program lets us know that we're paying about 0.5%, right? So adding up all of these expense ratios multiplied by the amount we have invested, we can come to 0.5% of 333,000. Which is roughly, what is that? A little more than $1,500 a year. That's just a mutual fund expense ratio. And then if you're paying an advisor 1% based on this, you're looking at $4,000 to $4,500 a year, which may or may not be obvious to you. The other thing is tax efficiency. Okay. And I'm glad, again, we have a taxable and an IRA account. Now, in general, as a general rule, let's say our friend here, Bush, is a 50-50 investor, 50% stocks and 50% bonds. Most advisors would make you a 50-50 investor in your taxable account and a 50-50 investor in your IRA. They own 50% stocks in each of these accounts and 50% bonds in each of these accounts. That would be incorrect. The way to structure this, given your IRA is a tax-deferred vehicle, right? You're not paying capital gains on any of the trades. If you sold something at a gain, you would not pay any capital gain. You wouldn't pay any taxes on the dividend income paid. You wouldn't pay any taxes on the bond interest income paid. All the growth is tax deferred. Given that tax deferred benefit, you would want to be potentially a bit more aggressive in the IRA. And of course, you need to pay attention to the dollar amounts of the accounts. And the IRA is a little bit more, so we're not going to go all the way up to 100% equity because that would skew us too much. But instead of 50-50, we might be 70-30 in here. In this IRA, we want that account to grow to maximize the tax deferred benefit. So 70-30 here, and then in the taxable account, instead of 50-50, we might be 30% equity and 70% fixed income. Now, depending on the tax bracket for Bush, that 70% in fixed income might be 100% tax-free bonds. If Bush is a high income earner, depending on his state, we might even drill down and get state specific, but we would for sure want to own tax exempt bonds. Now, if Bush makes zero money, he's retired, or his tax rate is super low, we might layer in some corporate bonds here, and it still might make sense given Bush's low tax rate, okay? So what I just described is asset location. Again, I have zero opinion about what the market does, but I'm optimizing where I own certain assets to boost my after-tax return. So we're going to be a little more aggressive, a little more equity or stock-centric in the IRA, and a little more conservative with the option of using tax-exempt bonds to mitigate or eliminate taxable income being spun off of this account. Because remember, in a taxable account, Bush has his dividend fund here. There's no way to shelter a dividend payment from taxes. Dividends are a popular factor in investing. They're hardly a sin at all. But if you were to own an income producing strategy, own it in your IRA and don't pay income taxes on dividends or taxes on your coupon bond payments. So again, dividends, no way to shelter these, and all the dividends that would be spun off of these holdings would be taxable, which is completely avoidable. Okay, let's go to portfolio construction. And, it's really not obvious to me what this advisor is trying to do here. It's just kind of like a random salad of assets, and not uncommon for US investors to have a pretty big home bias. That's one thing that jumps out at me. He's got an international sleeve here, so maybe I can take that back. But for most US investors, they have a massive home bias. And this is not just specific to US investors. If you went to Canada, most Canadian investors have a home bias for their own country. People tend to buy what they know. Throw in the fact that US markets have been on fire the last 12 years, give or take. It's easy to see a portfolio drift in the direction of your home country, especially given the positive performance of the US market. So in this, I would like to see a little more balance. There's some non-essential holdings or non-impactful holdings, some pretty small positions here. So go ahead and get rid of some of these small positions, add some emerging markets, add some real estate, add some small caps, just to balance out the asset allocation. Again, this is pretty top heavy in US large cap. It looks like, this is a very common thing to see folks allocated to tech, which again has worked really well. When you look out at the next 10 years, that outsized performance might not be repeated. So just a little more balance here. And then on the risk side, so Bush filled out a questionnaire quantifying or identifying his acceptable range of investment outcomes. And this goes to a scale from 0 to 100. So 0 would be like a portfolio of all cash. 100 would be a portfolio of small cap Israeli tech stocks, very risky. Bush is somewhere in the middle. So he's a risk score of 48. Okay. And when we click this, you can see that range of outcomes. So Bush let us know that his acceptable range of outcomes is -9% to 14%. That's great. When we look at his portfolio, Bush's portfolio, how he's actually invested is a risk score of 71. So, the bottom side in Bush's risk number of 48 was actually -9%, and that's with 95% confidence over the next 6 months. And I'll explain what that means in a minute. You can see this range of outcomes for a risk score of 71, combining his two portfolios, is much wider. So this is a riskier portfolio. Bush is taking more risk than he set out to. Okay. And again, this is within 6 months. So given the assets Bush owns, this is the potential range of outcomes based on how those assets have done in the past. And this is looking forward for the next 6 months. So you might say, hey, Nick, I've been conditioned to think long-term. I'm a long-term investor. And I would say that's fine. What we found is it's really hard for someone to stick to a long-term investment strategy if they don't understand the range of short-term outcomes. So that's what we're doing, is basically bringing risk forward, allowing you to understand the range of short-term outcomes. If this freaks Bush out, if Bush says, oh, I didn't know I was taking that much risk, we would go back to the drawing board and tighten this up, which we would probably do anyways, because Bush has let us know that he's uncomfortable with this potential drawdown here. The last thing is conflicts, and I kind of have already touched on this. This Morgan Stanley Growth Fund, this advisor probably received a kickback from the fund company in the form of the sales load. These structured note-like products, he probably earned a commission to sell, and I'm saying he, it could have been a she too. So this person, this advisor. And then this Wildermuth endowment strategy, I know this is not liquid. Not liquid is always a red flag, because usually the advisor receives an outsized commission to sell non-liquid stuff. It's really hard for non-liquid managers to raise funds. They often compensate advisors that place funds with them. So there's a couple red flags here. And this person, based on how they built the portfolio, I would say is not a professional investor. There's really no story here. There's no diversified, balanced portfolio. This is just kind of a salad of random investments, which, let's be honest, the last 10 years, it's been really hard to miss. So what that means is a bull market covers up a lot of warts. During a prolonged market drawdown, or even a lost decade like we had from 2000 to 2010, the sheets are often pulled back, and you can see the warts when we get a negative market event where you're taking more risk than you set out to, when assets that you thought were safe are actually risky. Assets that you thought were diversifying are actually risky. And I'm going to go back to the non-liquid, non-publicly traded strategy here. When the stuff hits the fan, these non-liquid assets freeze up because everybody tries to get their money out. If you fire sale an asset, if enough people want out, the price of those assets crater, which is why often you cannot get your money out during times of stress for non-liquid assets. So this portfolio has a bit of everything. It's not optimized for fees. You see this extra expense ratio of 0.5%. It's not optimized for risk. You can see Bush is taking more risk than he set out to. It's not optimized for tax efficiency. One thing I didn't talk about are these mutual funds often spit out capital gains at the end of the year, and you don't even have to sell anything. So you could own these funds for a period of 5 or 6 years. These mutual fund managers are buying and selling, trying to beat their benchmark, and they're passing along capital gains to the end investor. So Bush at the end of the year probably is going to have a pretty fat tax bill, even when he didn't understand what was happening. He didn't place any trades. He just owned these mutual funds, and he's still getting hit with taxes. So this is tax efficient on multiple fronts. If you're going to own mutual funds, which we don't own mutual funds at Pure, they're antiquated, they're a dinosaur, and they're going away. But if you do own mutual funds, do not own them in a taxable account, because you will get hit with capital gains. And then the last couple bullet points on conflicts, the non-liquid assets, the A shares, there's just a much better way to construct a portfolio. And notice all of these things that I'm talking about are things that Bush can control. So if Bush was our client, we would optimize the things we can control to give him a better probability of a favorable outcome. And again, a lot of people think because they work with a financial advisor that the financial advisor is on their game and they understand what's going on. They know how to build a portfolio. Remember, there's no formal training on portfolio management to become a financial advisor or to continue being a financial advisor. The barriers to entry to becoming a financial advisor are very low. And you might ask, Nick, well, why are you qualified to build and give me portfolio management advice? Well, there's a few things. One, I am a CFA charter holder, which is Chartered Financial Analyst. It's a graduate level program for portfolio construction, portfolio management, valuing assets. It's known as the gold standard when you're talking about the portfolio management space. It took me 5 years to achieve. There's only a couple 100,000 in the world. So I feel very qualified to speak on these topics, and know that we also have another CFA in-house as well. We do all of our investing in-house, so we don't outsource to any third party. We know exactly what we own. We build risk-efficient portfolios and tax-efficient portfolios. So those are the pillars. If you have any questions, feel free to respond or send us a note. If you'd like us to do this analysis with you, we'd be happy to record a similar video, just sharing our observations and point out some of the low-hanging fruit that we can help you pick off to give you a better chance of success.